Hi everyone and welcome to this week's webinar with me, Richard Perry, Market Analyst at Hantec Markets. I hope you're having a good day. I know it's very lovely weather in London and I hope it is where you are too. The webinar that we're looking at today is trading with moving averages. Now, this is, I believe, going to be an interesting one, I hope, for you. Because I think moving averages do a lot for traders, and a lot of traders around the world do use them and give a lot of weighting behind them. So I think it'll be one that hopefully will give you a lot of information and guidance as to how best to use them. I'm going to start off with my usual disclaimer. This is the risk warning that I've got to use because we're going to be talking about live market information. I'm going to be playing it again at the end of the webinar, so if you do miss it now, then do not worry because you will get another chance to see it. This bit is me. I'm going to gloss over that. I think I really don't want to be talking about too much about that, but anyway, that's me. Right, okay, what's the webinar agenda today? Well, the moving averages, we're going to be talking about different types of moving averages, different lengths or I suppose days or periods of moving averages, and also over which time scales you can use them as well. So that's a little bit of theory. Then moving on to the different practical uses of moving averages in the market, which is where I think it will get a little bit more interesting, hopefully. And that is where we can use trend identification, use of support and resistance, and then finally buy and sell signals of moving averages. So lots to use there. And then towards the end I'm going to be talking and just having a look at a few live charts in the market, drawing in a few of the other indicators that we've learned about and a few that we will be learning about in the coming weeks, and just to give you an idea of what my current views are in the markets, because I know a lot has been going on recently and it is quite an interesting time at the moment. At any stage at which you feel the need or want to ask me any questions, please absolutely feel free to write in, and I will answer questions as and when they arise, hopefully. And if I do miss any questions, then please feel free to write in. I will give you the details to contact us at the end of the webinar, but I think it's marketing@hantecfx.com, and I will do my best to get back to you as soon as I can. Okay, so starting off with, as I said, with a bit of the theory. You've got different lengths of moving averages. You've got simple, exponential, and weighted moving averages. 3 different types, and 3 different calculations on how to use them. First of all, obviously, simple is, as what it says, it's the most basic form of moving average, and it is basically just a mean of the prices over a number of periods. I'm going to use the term. I'm going to use days because it's just easier than saying hours or months or weeks. So if you are, for example, looking at the 3-day moving average, you take the average price of the past 3 days, and that's where your moving average would sit. Say, for example, you've seen 90p, 100p, and 110p over the last 3 days. Your moving average would be at 100p. So that on a simple basis, and that's basically where we sit now. So that is the most common form of moving average, and it is the one that I think a lot of people tend to use the most, because it's well, I mean, for no real reason other than it. I mean, to be honest, the simple moving average is the least responsive of all the 3 moving averages, so maybe that is why, because you tend to get a little bit more whipsaw with the other 2, and the other 2 are weighted moving averages and exponential moving averages. Weighted moving average is also classed as, or called, a linear weighted moving average. It basically gives far more emphasis on the current price than it does from the prices several periods ago. So basically you weight it accordingly. So the current price is weighted the most and down the scale on a progressive basis to the least weighted. So say for example, again on a 3-day basis of moving average, if you did use a weighted moving average, you'd say for example multiply by today's data by 3, yesterday's by 2, and the day before's by 1, and then divide by 6 to give you a weighted moving average of that. So that is going to give you a slightly more skewed towards the price movement moving average, and it gives you much more responsive moving average than simple. Some people like it because it is more responsive, but the argument against it is the fact that, as I said before, it can give you more false signals when you use it. So that is the argument against it. But the third one, exponential, is a similar sort of basis to weighted moving average, but the calculation uses an exponential smoothing method rather than a linear smoothing method. If you wanted me to actually talk you through exactly how to calculate an exponential moving average, I would just say look it up on the internet, to be honest, because it's fairly complicated, and again it gives you a more responsive moving average than your simple moving average. I will show you quickly now how that works in practice. And this is your three moving averages. This is cable using the 55-day moving average across the simple, exponential, and weighted bases of calculation. Now you'll see that the red line, which is your weighted moving average, tends to be closer to the price than your exponential, which is your blue line, and even and less. And the least responsive is your simple moving average. To be honest, I've always used simple moving averages, and that is purely for the basis that that's because I've used them, nothing really more than that. I would say to you, if you were really that interested or that inclined to use the other moving averages, maybe give them a go, see how they work out for you. They may suit your method of trading, they may not, but just I would say test them before you just start to use them, but I use simple moving averages as a rule. Okay, so which lengths of moving averages you use? Now, I always, if you actually look at my videos or read my analysis, I will always use the Fibonacci numbers as my moving averages, so that's 21, 55, 89, and 144. I have in the past in my analysis used 20, 50, 90, and 200, and it just depends on what I mean, on your point of view, really. I mean, round numbers are quite popular, but Fibonacci, it brings in more of the mathematical phenomena that is Fibonacci into the moving averages, so it gives me a little bit more confirmation effectively that I think that they would be working. To be honest, it is again each to their own. You can try whichever method you choose, and it's whatever you think's best and whatever fits you. And the other thing being, just bear in mind that no one moving average is going to work across everything. You could use a 55-day moving average, say for example, which is currently working, I think, on dollar CAD, but the 55-day moving average doesn't work so well on cable at the moment. The 89-day moving average works really well on cable. So what I would say is basically have on your charts a number of moving averages that you can refer to, and you'll see that they are used for different situations. I mean, short-term corrections, long-term corrections. It just helps to give you more of a guide in terms of your price action, and I think that they are very important for that. But yeah, just bear in mind that no one size fits all. So just keep that in mind when you're trading. Okay, so on to moving average uses. Now, there are three different uses that we're going to talk about today. First of all, trend identification, and then support and resistance, and then finally different trading signals you can gain from moving averages. Trend identification, one of the biggest uses of moving averages is the fact that they are effectively just they depict the trend on the chart without you having to draw it. Because they are the average of the price action over a period of however long, they give you effectively an accurate trend line of where the price action has been and where it's moving to. So I think that for that reason, I think they are very important, and they give you an instant idea of whether you want to be long or short, because effectively across your trading, you don't really want to be trading against the trend. That is one of the quickest ways to book a loss on your trades, is to trade against the trend, and subsequently you don't want to be trading, I think, against the moving average. It can be a trading strategy that you want to employ, but I think it's a very risky trading strategy. The other thing being that just the reason that we also have multiple moving averages on charts is that you have different outlooks and different time horizons for your trading. You have short, medium, long term. So subsequently, your shorter term moving averages, say for example your 21-day or 55-day, depict the price action over that length of time. So I mean, 21 days is almost a month, 55 days is almost a quarter, so you can get a gauge on how the price action is moving through that period. But then when you increase across 89 and 144, in the instance of the moving averages that I use, then you go to more medium to longer term outlooks, and especially important, I think, with Forex trading as well, which is a bit of a shorter term outlook on the market as well. So it's I think it's interesting in that regard. Different, as I said. So the reason I was saying that is basically because you've got your short, medium, long-term trends, and basically if you've got a load of longer-term moving averages that are advancing, and then your near-term moving average, which, say for example your 21-day moving average has turned lower, and you think, okay, well I'm going to start shorting, that is trading against the macro trend, and that is as I said earlier, that is generally a risky trade. However, if you're looking at a chart and you see all the moving averages moving nicely higher, this is certainly a chart that you want to be long of, and using any corrections as buying opportunities rather than trying to short, because as I said, shorting against the trend is a bad idea. Okay, so basically that is the reason why we look at moving averages as trend identification. So you're not trading against the trend. Okay, support and resistance is the second very important way that we look at moving averages. Support and resistance on moving averages I will show you in a series of charts. Okay, so second chart, that was the 55. Okay, yeah, that's just the differences on the moving averages that you can see on euro dollar. No real difference across the different numbers that we use. The Fibonacci ones there, very similar to your round numbers. So it's again, it's each to their own. Okay, so this is okay, right. Across the support and resistance lines, okay, so you can use moving averages as support and resistance, basically because they tend to crop up as basis of support and resistance on several occasions, and when they do that, the more often they do that, the more conviction you can use in your trading and your use of moving averages, but also the more important it becomes when that that moving average is broken. Now this is euro. I've noticed that over the course of the past year, you've seen that the 144-day moving average basically has been the support through the uptrend, and then has now become the resistance as we've turned lower. So basically the 144-day moving average has turned lower, and that would suggest that it's now becoming the resistance to the rallies, and that is just something that tends to happen with increasing frequency on the euro. 144-day moving average, again, I've talked about this so many times on gold. This is across the past 6 years. Gold, look at the amount of times that the gold price in the late 2000s into 2011, 2012, the 144-day moving average was used on time and time again as the basis of support for gold. It then started to break down in early 2012. But since then, in 2013, it's once again become the basis of support and resistance again. And what I'll do is I will zoom in to show you 2013, this is across the last year. It's then become the resistance and then back into being support again. A little bit of resistance there, but again it's being used as the basis of support. So this is where the 144-day moving average, I think, is again a key indicator on gold. Very interesting moves there on gold. On cable, 89-day moving average currently. Over the course of the past year, the 89-day moving average on cable has been hit numerous times. Just not so much at the beginning, slightly there, but then on the last few major corrections on cable in 2014, the 89-day moving average has been hit pretty much bang on and used as support. Interesting that we're still trading slightly above there, and that is possibly well back towards the 89-day moving average again before we rally off is another matter. Now, one of the things you can do with moving averages is use them as a retracement. One of the methods of trading, I did say that it is a risky game to trade against the trend, but one of the things that you can notice with moving averages is that it's similar. I suppose if you've looked at Bollinger Bands at all, it's a similar sort of thing where the price tends to stick within a limit of a moving average. It doesn't tend to trade away from a moving average for very long. It doesn't tend to get too far away from the moving average before you start to retrace it back towards it. And that is one of the reasons why some people do a lot of trading whereby you can trade in the direction of the moving average, but then obviously you get to a certain stage at which you can, say for example, do some back testing onto how many occasions that a moving average has gone beyond a certain distance away from a price, and you can start to trade with that. So again, there's a lot of back testing involved in strategies like that, but it is something that has a place in trading and potentially could be successful. Okay, so dollar CAD, 55-day moving average on dollar CAD has become the basis of was the basis of support. So that's turned lower and is now the basis of resistance. So the 55-day moving average on CAD. And finally, on the Euro Sterling chart, the 21-day moving average is an excellent basis of resistance. and has been for the past 4 months. And once again, to be honest, it's done it on several occasions throughout that 4 months. And as you can see here, as I spoke about earlier, you can get a gauge of the fact that it shadows effectively the trend. So if that would, I mean, downtrend is not bang on accurate, but it's not a million miles away from being that. And you can see that within that downtrend, you've got your moving average that shadows that downtrend. So that is what we're looking at there on Euro Sterling. Now, the chart that I was going to look at earlier that I just brushed over quickly is the fact that you can use moving averages on different time scales, different time horizons, hourly, weekly, monthly. However, they still have a place in moving average analysis. This is the euro again, and you can see through here, through June 2014, this is the 144-hour moving average, which provides a base of support, and it's a little bit messy. It's a little bit messy, I'm not going to lie to you, but we'll see how that works on a weekly basis. This is the weekly. Yeah, not too bad. 21-week moving average, which if you multiply that by 5 to make it a daily moving average, that's pretty much the 100-day moving average. So that's not a million miles off. 21-week moving average. Right. Okay, so that takes me on to the final way we can trade with moving averages, and that is that we can use moving averages, and that's with trading signals. Now, trading signals on moving averages are it can be a bit risky. Not going to lie to you, they can be a bit risky, and I would recommend, as probably with all trading anyway, so I'd recommend doing multiple confirmation on trading rules. So if you do get a trading signal on a move with your moving averages, then ideally you'd probably be looking for other confirmation signals as well to give you increased conviction behind your trading. But I think that's basically the case with all technical trading anyway, so multiple confirmation is advisable. Moving averages work best in trading conditions that are trending. So when you use moving averages in a sideways trending market, or no trend effectively, it tends to get a little bit more whipsawing. You tend to come in and out of trades very quickly and also unprofitably quite a lot of the time in no trending markets, and that's basically because moving average is depicting a trend, and when it's sideways, then basically your trend is going sideways, and your trading signals will give you basically no signals that are very useful at all, really, because it's a sideways trade and you don't really know whether you're going up or down. So that is why it's best to use moving average crossovers and pricing moves in a trending market. Now, there are two different ways of using moving averages in trading signals. First of all is perhaps using a price cross over a moving average is one way of doing that. I think it is probably the riskiest way of doing it, where you trade when the price crosses above a moving average. You then start to go long, because effectively the price will start to pull the moving average higher. It is I think that's the signal that you're most likely to get false signals with, but it is a method of trading. In that instance, you could, or probably would be advisable, to maybe wait until the moving average does start to turn higher in that instance, but that is one way of doing it. Now, the main way that I look to use moving averages is for moving average crossovers. Now, what I will show you now is a chart that I got very excited about today when I was putting this presentation together, and that is on euro dollar. Now, basically, the idea being that you use two different moving averages, and you trade when the shorter moving average crosses over the longer moving average. Some people call that death and golden crosses. A death cross being when the moving average turns below the longer moving average, and the golden cross being the opposite of that, when the moving average turns above the longer moving average. I go a little bit more conservative than that. I like to, I think the most conviction you can get out of a moving average crossover is when they cross over when they're both moving in the same direction. So your golden cross is when both moving averages are rising. Now this is the method on Eurodollar, and I think, and maybe you'll disagree with me, but I think as a longer term strategy, this works absolutely amazingly on Eurodollar. When I'm using two moving averages here, 55-day and 144-day. I will caveat that by saying that again, do your back testing, do your research, and figure out which moving averages work best for you. Because again, this is Eurodollar, and what might work on Eurodollar may not work on cable, may not work on dollar yen. So this is Eurodollar, and this does work, or certainly does seem to work on a longer term basis. This is since 2008, so this is long-term trading, I suppose you could say, but still it sort of gives you an idea of how you can use it. Look at this. Pretty much every time you've had your signal since 2008, it's pretty much worked bang on. So on Eurodollar, you've got a crossover here up in late August, and that was a bearish crossover, so you're shorting, and you remain short all the while this the shorter moving average, the 55-day moving average, is trading below the 144-day moving average. Now, within this scenario, you can do different trade management strategies to make sure that you basically aren't giving back a lot of your profits, but to all intents and purposes, I will stay long whilst the 55-day is above the 144-day, and short whilst the 55-day is below the 144-day. So that's basically just to show you this. But look here, so you've got the 55-day crossing over below the 144-day. You're then in that trade for, good lord, 8-9 months, but you've seen probably a movement from $1.47, and you're out at $1.31. So it's a long way. You're in that trade for a long time, but it gives you a big profit. You then reverse that trade because your 55-day moving average has crossed back above your 144-day. You're then long. So you stay long effectively until here in February 2010. Not a huge amount of profit there, but again, as I said, trade management and effective trade management can secure you with a much better profit than the way I'm playing it. How you do that is probably you would stay in the trade whilst the 55-day moving average is rising. That is probably the way to play this on an effective longer-term basis to maximize your profit, because effectively when you've seen the 55-day moving average turn lower, then the outlook is beginning to deteriorate on the trade. So I would probably say if you make most profit out of this strategy, you'd stay long whilst the 55-day moving average is trading above the 200-day, sorry, the 144-day, but also when the moving average is rising. So as soon as the moving average starts to turn lower, then you'd probably start to think about either shaving your position, trade managing it, or coming out entirely. Okay, so you've gone, then you're back below. You've had another signal in 2010, February 2010, where you're now short, and that you're short all the way until here. Again, your 55-day moving average is falling for about 6 months in total, and only when you start to see it rise is when you start to think about your trade management again. Interesting. Again, okay, you've now had your another signal, your crossover there, and your 55-day moving average. To be honest, you'd probably be in it. Yeah, again, you're in and out maybe over the course of a quarter, a couple of months, and maybe on that strategy you would have lost money, but it's not often. If you'd stayed on the original strategy, which is when you're for 55 days trading above the 144 day, then you actually would have made money on this trade. Okay, but you can basically get a gauge of throughout the course of the last few years, you've had 1, 2, 3, 4, 5, 6, 7, 8, 9 trading signals, and you've pretty much made money, I'd say, on at least 7 or 8 of them. The latest one, this is important, the latest one, we've just had a bearish crossover on the 55 and the 144-day moving average on euro-dollar. That crossover came at the year end of June, and we are currently now in a short bearish scenario on euro-dollar. And why would you not be, to be honest? And I'll show you towards the end why that is, I think, going to be a very profitable trade ultimately. So yeah, so we're currently in that scenario. Okay, I've just got a question. Would you enter now then? Well, if you're doing this strategy, you would be already short. You'd be short at the beginning of July pretty much, and you would have also then taken advantage of all this downside that we've got here. On euro-dollar, I'll quickly show you. This is actually euro-dollar now. I was going to do this towards the end, but I can do it now. You've got this enormous, we talked about multiple period price patterns. You've got this enormous head and shoulders top pattern now on euro-dollar that is now completed yesterday, actually completed yesterday, on a move below that 134.75 support, which was that key February low. We've now broken that. We've had a couple of days, and to be honest, I'm still looking for a second day of a confirmation close below, but still I think this is a big pattern that is ultimately going to be a very bearish pattern for euro-dollar. On the 55, that red line there is the 55, and we've got the black line there, which is the 144. So you've had your red line cross over your black line. That was in late June. You would have been short since then, but also since then you've got a death cross. This is a pure breed death cross as well, on the 89 and 144-day moving average. All the moving averages are turned lower, so you want to be short of this. This is definitely a chart you want to be short of, and that, as we spoke last week about the downside target of this big top pattern, actually, if you measure it from this peak here, if you want to go ultimately ultimately aggressive, then you can measure it from the ultimate peak. But I measured it from this peak here down to the neckline, projected lower, and that gives you almost to the pip, $1.30 big figure as a downside target. So you could get another 400 odd pips to the downside on this euro-dollar chart. So I think there's so many confirmation signals that tell me that euro-dollar is going lower now. The only caveat to that I would say is that on this RSI you're a little bit stretched to the downside, which might see you get a bit of a technical rally. Technical rally in this euro-dollar chart would probably be even more profitable, because that would give you a nice bounce into probably a resistance band around about that $1, maybe $1.35.75, which is the old support turned into resistance. But I think this euro-dollar chart, I'd be definitely selling on a longer term basis selling any sort of rally that you get on euro dollar now. I think it's a very interesting downside play, and as I said, you've got a lot of confirmation signals that suggest we're going lower on euro dollar. And again, if you look on, I mean, I probably shouldn't be talking to you about this in a technicals chat, but the fundamentals certainly suggest that the outlook for the Fed is going to be tightening. The outlook for the ECB will be loosening monetary policy. Two diverging monetary policies suggest certainly euro dollar will be going lower in due course. Okay, so pretty much that's the theory covered, and also what we've seen in the live markets as well on moving averages. Now I will take you through a few live charts. And that, I mean, to be honest, we've now spoken about euro dollar, so that's euro dollar done. Just zoom out slightly. That is that target down there of $1.30, and that is the, as I said, the vertical distance measured lower, and that takes you to $1.30, a big downside target. You've also got your interim target, which is still in place, which is this big double top pattern. That gives you a downside target of 33.75, still in play. So I think that, again, that's another indication to me, along with the moving averages that have all turned bearish and the momentum indicators, which are also bearish. I'm going to look at momentum indicators in the next webinar. But the outlook, I think, is increasingly bearish on euro. Okay, so cable. Okay, I've got another question. Sorry, one sec. Would you use these moving averages for Euro Japanese? Interesting. Okay, well, seeing as you mention it. Euro Japanese. Well, I think generally dollar yen, euro yen, whatever, is coming back for a test of this big key February low. And if you look at these moving averages again, look at this. You've got 144-day moving average, which provided the basis of resistance, sorry, support, sort of now turned into a bit of resistance also. That's all moving lower. Just zooming in, do we have a basis of resistance? It's not amazing. It's not amazing. But you'd still certainly say that there is, I mean, you'd basically just get from that the moving averages are all in bearish sequence. In terms of the exact moving averages, they don't, they're not being used specifically as support and resistance, it would appear, from this chart. But certainly the downside pressure is on. You've got all these moving averages falling in bearish sequence, and yes, I think a test of this key February low is what we're going to be seeing in the due course, which is not a million miles away. But if you then zoom out, you'll see that effectively then you'll probably be coming back towards the next key band of support, which comes in around about that 131 mark. So that is the next stop, really, on a key basis anyway. But certainly euro yen is looking increasingly worrying. Once again, the yen seems to be, for some reason, seems to be one of the stronger currencies at the moment. It's actually stronger than the dollar at the moment, which is surprising considering that the dollar is supposedly on a tightening cycle, or possibly coming to the beginning of a tightening cycle. But maybe when it actually starts to happen, that's when the dollar might start to find a bit of support. But certainly euro yen looks pretty negative as well, falling under this key support. which has subsequently been used as the basis of resistance. We've seen that at 140, and again, if you zoom in here, excuse me. If you zoom in here, you can see that you've got your next resistance, your first resistance at 137.60 is your first resistance on euro yen. It's not too bad actually, having thought about it. Just the last month or so, the 21-day moving average has not been too bad. But yeah, I mean, I'd be a little bit. The moving averages are okay. They're not great on euro yen. Okay, cable. Now, as I said earlier, cable, this 89-day moving average, this blue one here, is a great basis of support and resistance for this big bull run in cable over the past few months. It's been used time and time again. However, what we're seeing at the moment is a slight correction, slight consolidation, drift lower. But I just see that that's coming in towards this the support of this breakout high, this old breakout high, which is bang on $1.70. If you remember, in that May period, it struggled around that $1.70, and then did it a couple of times, 2 or 3 days, and then started to use 170 as the basis of support. 169.50 is probably the key support that you'd be looking at now on this trading band here. $1.70 up to $1.70.60 was that high there. Is the band of support. Now what we're seeing is today a dip into that band of support. I'm now I'm not going to go long quite yet, because I think I'd rather wait and see for a buy signal on this cable chart. Haven't had one yet. What I'm thinking is ideally it's going to happen within this $1.70 to $1.70.60 area. You could even get a move back towards that 69.50 area, but the only concern I would have within this is that you might see this gradual drift whilst the moving average, the 89-day moving average, catches up. 68.66 is at the moment, so it's still 150 pips, bang on, 150 pips below where we're trading at the moment. So just keep that in mind, because as I said, you do tend to see these corrections that drift back. I mean, over the course of the last couple of quarters, where you've had that big break higher, you've then seen a consolidation move that's just drifted back to the moving average, the 89-day moving average. So you've had once there at the beginning in February, the strong move higher, then drifted back, and then the strong move through April, and then drifted back. So you might see that happen again, and that would be, I'm not hoping that that's going to be the case. I think that cable is going to start to form support not a million miles away from where we are now. But yeah, I don't think that it's going to go. Well, I'm not expecting it to go back to this moving average, but it could quite easily do it. Okay, sorry, I've got a few questions here that I'm going to try and just get a gauge of. Okay, here we go. Right. Okay. Oh, sorry, Linda, I didn't see that question. 10-day moving average and the 21 has crossed on the daily chart. Okay, which I'll ask you to just quickly ask me which currency that's on. Can you tell us which moving average you use for the different currencies? Seems you use 4, and how do you use them in your trading plan? Okay, cool. Well, as I said, I use moving averages generally as a gauge just as one of the multiple tools that I use for analysis on the markets. I will use moving averages to just give me a gauge on that. As I said, I use moving averages, personally use moving averages for pretty much all of the trading signals, all of the factors that I spoke about through this webinar. Certainly use them for trend identification and support and resistance are the two main ones that I use. Not so much in terms of trade identification. I like to use pattern analysis a lot for my trade identification, and also one day and multiple day signals such as key one day reversals, things like that I like to use. But I think the main basis of moving averages, in my opinion, is support and resistance. And for that reason, as bringing it back to cable, in what I've just said, there's an argument to say that this drift back on cable could continue in due course. But yeah, the moving averages that I do see is on different instruments. Sorry, are the 89-day moving average on cable, 144-day moving average on gold, and etc. etc. So just different moving averages for different instruments. And you just, again, you just need to just do a little bit of back testing research, maybe just look at your charts over the course of history and see what's worked, because what tends to work will work again on moving averages. So yes, that's that. But that's outlook on cable at the moment. It is drifting, but I'm expecting at some stage, not too distant future, I'm expecting some sort of buy signal on cable, and then I think we're going to be retesting the highs again, because if you look at the big long-term trend on cable, we're still very positive on cable. There's no reason to be bearish on cable whatsoever. It's just in a corrective phase. Okay, dollar yen. Now dollar yen is, I'm not going to swear, I don't like dollar yen, purely for the reason that it has almost no trend whatsoever. It has, just over the course of the past few months, it has periods of 3, 4, 5 days of moving in one direction, and then will completely and utterly reverse its direction for the next 3, 4, or 5 days. Just gives means that trading dollar yen is incredibly difficult, and it's not particularly profitable because the movements are so small. But that is, crikey, what's going on there? Anyway, but that is dollar yen. In terms of what we're looking at the moment, I think moving averages are forming my view on almost a daily basis on dollar yen now. So you've had for the past few months all these moving averages just very mixed, very mixed, very mixed, but all the while they're gradually now just all turned lower in bearish sequence, and I think that gives me an indication that we're going to be going lower, I think, on dollar yen. I'm not especially confident that the support, the February low, will hold. If you look back on euro yen, you'll see a very similar sort of story, where that key February low will be, it looks like it's being tested as we speak. It's not a million miles off on euro yen, and I think on dollar yen, again, a very similar story. Dollar yen, at the moment, the 89-day moving average has capped the last 2 rallies, and that comes in just above 102 big figure. What we're seeing at the moment is it's struggling to get back above the 21-day moving average. So I think trading on dollar yen is very difficult, and to be honest, I mean, I'm going to actually show you on an intraday basis, because I think it's probably much easier. You see here on an intraday basis, dollar yen, zoom out. Just look at the support and resistances you've got on dollar yen. 101.60 hit bang on. If you zoom out, 101.60 is quite a common feature on dollar yen. Had support, became resistance. Didn't really do a great deal here, but again became resistance. A little bit of support back here, and then resistance again. So it is a common theme on dollar yen. 101.80. Same again. Lots of resistance. Used as a bit of support through here, but mainly used as support through this period here. Old support becoming new resistance. And these pivot levels across the course of time do act again and again and again. So that 101.80 level on dollar yen, I think, is a big resistance now. But yeah, I'd be using any sort of rally on dollar yen as a chance to sell, because those moving averages on the daily chart, coupled with the momentum indicators as well, which have all, I mean, they're not massively bearish, but they're certainly not positive in any way. The RSI keeps falling over at lower levels. MACD lines below neutral. So yeah, just not great chart. I mean, it's not a great chart to trade at the moment, and I'm not a massive fan of it. But if you do have to trade it, then I'd be trading it as a sell into strength. Okay, gold. Gold. Just very quickly, we've got a question. No, we haven't. Linda, there we go. SMA on GBP USD. Okay, fine. So let's go back to GBP USD for Linda. Right. 10 moving average and 21 has crossed on the daily chart. Okay, so what we can do is we can add in a moving average, 10, give it a nice pinky purple. Yeah, well, there you go. Okay. It has indeed crossed the 21-day moving average. Again, in fact, it's not really something that I focused on during the chat, but what you need to be doing, if you're looking at the 10 and 21-day moving average, that is across a very short-term time horizon. So if you're looking at very short-term moving averages, your trading horizon is going to have to be short-term. Now, that is a short-term trading signal. If you've looked at that previously and it works, let's look back here. Does it work? Yes, it did work there. The bull crossover didn't work in February. Bear crossover did. Bull crossover definitely worked there in April. Bear crossover did work. Your bull crossover worked. Okay, well, so you'd say that the last few ones have actually been not too bad on the 10 and 21. 10-day moving average, not a moving average that I often use or ever really use, but obviously that has got some grounding there, so it is potentially going to be a signal. So what does that mean? Well, does that mean that we're going to now enter into a bit of a short period on sterling dollar? Well, we're still above, as I said, 150 pips above that 89-day moving average, which is where the medium-term corrections come back to. And again, as I said earlier, it's all about perspective. Whether you want to be shorting in a big uptrend, you've got to be very close with your trade management, I would say, in that instance. It's a risky strategy. It's not. It doesn't necessarily mean it won't work, because as we've seen throughout this, certainly the bull cases tended to work. Apart from that one in February, the bull cases that we focused on, certainly that big one there in early April and the big one there in June definitely worked. The bear cases, you had a few days worth in March and a few days worth in late May, June. So I'd say it's, just be careful, I'd say it's a short-term trade because of the fact that we're in such a big long bull run in cable, and I would stay very close to your trade management is all I would say on that one. But yes, it's a good spot. It is a good spot. So just another question. Sorry, my eyes are a bit rubbish. Actually, what would be the time horizon of a trade based on the moving average period you are using? What would be the time horizon? Well, if you're talking about, as I said, the 10 and 21 day moving average, well, 10 days is what, 2 weeks. So it wouldn't be a long trade. I'd say it would be across the course of maybe a week or two at most. Because I suppose I mean, if we just go back to that, if I just think back to that euro dollar 144 day moving average and 55 day moving average outlook, most of the trading periods seemed to be a matter of maybe 3 or 4 months in terms of horizon before you start to get a turnaround, and that is pretty much the length of that 55-day moving average, which is around about 3 months. So maybe I'm just thinking out loud here, really. Maybe it is sort of according to the shorter day moving average, because that is the one that's going to be whipping you in and out a lot more quickly. So maybe that is your time horizon, anything up to 2 weeks. I would say. So that is actually a very good question, and hopefully I've answered it reasonably. Okay. Okay. Well, there's been a question asking about Aussie dollar, so I will move on to Aussie. Aussie dollar. Here we go. Right. Well, there's no real moving average crossovers that we've had in recent times, but is there any support resistance? Well, your 55-day moving average has not been too bad. In fact, it's been pretty good on Aussie dollar. Worked well through February and March. A little bit of a breakdown in May and June, but then since then, in June and July, it's been excellent. It's been the support pretty much on throughout. Now, I was thinking that perhaps a bit of dollar strength would turn this into a head and shoulders top, and it very close and almost did it. That 93.20 level on Aussie dollar was very close, but we've had a strong reaction off that 55-day moving average once again. So it's now testing to the upside. I think it needs, obviously, the initial test is that reaction high at 94.53, but then that reaction high at 95, around 95 big figure. So if you can break above that 94.50 area, I think that would certainly be a bullish move, and it certainly looks from the reaction of that 55-day moving average that it's becoming increasingly positive again, and that this head and shoulders top pattern, which almost performed, it didn't quite do it, and that 93.20 mark still was the basis of support. It's been a very nice pivot level throughout the past few months on the Aussie dollar, and that is where we bounce from again. So Aussie's looking a little bit more positive once again. Right, gold. 144-day moving average, as I said earlier, has been very good basis of support. It's not exact. It's not exact. Moving averages, again, they don't tend to be an exact game, but certainly you'd be using it as a very good gauge, and that on that downside. I think the outlook on gold near term is very mixed. You've had a lot of mixed signals. You've had a sharp move to the upside, sharp move to the downside, sharp move to the upside, and now it's drifting off again, and that is on the geopolitical events quite dreadful events that have been going on in Ukraine over the past few days. Certainly not helped that, the gold chart. But it seems to be that that situation is calming down now, so perhaps the geopolitical driving force behind this trade is going to start to dissipate, and technicals will take over. In that scenario, I believe that gold will, there's a lot of things that's going on in this chart which suggest to me that gold is beginning to improve again. You've got this broken downtrend that's been dating back to October 2012, support of that rising moving average, which is the 144 days, and also these momentum indicators which are in bullish configuration. So I'd be saying that all things remaining equal, and that is always a caveat because geopolitical events take over gold very quickly. I think all things remaining equal, gold is beginning to improve as an outlook on a longer term, on a medium to longer term basis. Very near term, I think it's still a bit choppy, and it's quite a difficult call. Okay, couple of indices very quickly. S&P 500. Crikey, come on. Well, you would certainly say that this 21-day moving average seems to be pretty good over the past few months on the S&P. Not exact, once again, not exact, but it still is pretty good. You've still got this big primary uptrend, which has been in place. Quickly zoom back. It's a long time ago. Q4 2012. So very strong there. Strong chart, and again, we're breaking out on S&P 500. What is there going to stop this bull run on the S&P? Certainly apparently not geopolitical events. It's going to take something else, but certainly you'd be running with any sort of corrections as buying opportunities in this S&P 500 chart. Don't bat against the trend. It just hasn't worked. It just has not worked. You might get the odd occasion where you'll pull back towards this primary uptrend, which currently comes in at 1925. I suppose that is 63 ticks, 63 pips, but still, I think it's still going to be a very risky trade if you want to bat against the S&P 500. It just wants to go higher, and earnings season seems to be driving it forward as well. It's just going higher, so I think any sort of correction in the S&P 500 is a buying opportunity. There's nothing really more you can say about that. DAX. If I can type. It's a 4. Hit that 144-day moving average. Now, I've got another chart, actually. Have I? Yes, I have. This DAX chart, 144 and 200 this is, on a longer term basis, being used as the support level. It's not bad, actually. It's not bad. The 200-day moving average seems to be pretty good on the DAX. But also the 144-day as well seems to cap the minor corrections, the lesser corrections. So I would say that anything that comes back towards this 144-day moving average is still a buying opportunity on DAX, and that just seems to be what we've had again. On a longer term basis, this index certainly looks positive still. This is with a lot more indicators trading with it. You'd certainly say that the primary uptrend is, I mean, it was only breached on one day, so you'd say that that's still largely intact, and also with the bounce off the 144-day, that's a positive. Additionally, this support now that we've got going around 9,600 is a positive. Now, on the caveat to that is the fact that DAX has been unable to break through 9,800 today. 9,800, which is a bit of a pivot level on DAX. Pretty much hit 9,800, yeah, 9,802. So pretty much bang on, and then fell away. So you'd want to get DAX above that 9,872 mark before we start to get really more excited. And the reason being, back on our moving averages, that this 21-day moving average has, in the last few months, been pretty good. pretty good basis of support. Slightly breached on the upside there, but then again it's become the base of resistance on the reaction high there, and again today. So your immediate reaction would be that you need that to break to the upside. You've also now crossed below the 55-day moving average on that, so maybe that is a signal there that's not as positive as the longer term chart would suggest. So a little bit of mixed trading signals there on the DAX, but certainly the reaction off that 144-day moving average is a positive. Finally, I'm going to look at FTSE. Again, oh God, look at FTSE. I mean, how can you trade that at the moment? It's just all over the shop. No conviction whatsoever in FTSE over the past 3 months. Just up, down, up, down, up, down, and even then, in the last few weeks, the moves have become ever more accentuated. So, how do you trade FTSE? I'd avoid it personally. It's a nightmare. It broke that primary uptrend that have been intact since. That's a pretty good uptrend as well, by the way, on FTSE that it broke since Q3 2011. Broke that uptrend, and quite significantly actually. So I'd say that's a concern of mine over the longer term. That not only have we been unable to break out on the upside, that FTSE has broken that key uptrend. Since then, we've had a bit of reaction to the upside. Do you go with it on the long side? Well, you've broken out above this reaction heights around 6,800, which, as I was going to say, 6,800 is a pretty reasonable pivot level on FTSE. Slight breach to the upside, but actually you've corrected back below it, 6,796 currently. I mean, I'm not convinced either way on FTSE at the moment. I think there's, again, with both DAX and FTSE, there's a lot of conflicting signals going on. If you look at the momentum indicators, pretty neutral really. I think it's a very difficult one to call. Very difficult one to call. Okay, so if you've got any more questions, well, feel free to email them in, and I will take a look at them and get back to you personally. So that is the end of today's webinar. You've got that PDF document that that we sent over to you. I hope you've read it and you found it useful. And I also hope you found this webinar useful as well. Lots of questions today, so I'm taking that as a good thing. Next trading webinar is on the RSI, which we've focused on a little bit over the last few weeks, but not really told you how to trade it properly. So hopefully my webinar called Top Trading Signals with RSI will give you more of an insight into that. That's on Wednesday the 6th of August. I will wish you good luck with your trading. I hope I have been helpful for you today with moving averages, and I'll speak to you in a few weeks' time. And here is my disclaimer for anyone who hasn't seen it yet. Okay, thank you very much, and I'll see you later. Thank you.